Today's episode is brought to you by Blockfills, powering digital trading. It is my pleasure to welcome to Forward Guidance William Isaac, Chairman of the Secura Isaac Group. Welcome. Thank you so much for joining us, Bill.
Great to be with you, Jack.
So, Bill, you were the chairman of the FDIC, I believe, from 1981 to 1985. At the young age, you were younger than 40, running the FDIC. So how does one get that job? I mean, I want to know, people want to know how, if you're, in your mid 30s, how do you get to be running incredibly important, backstop for the American banking system?
That's a good question that a lot of people ask. Sometimes I ask myself. But I was actually appointed in 1978 to the FDIC board. It was a 3-member board, bipartisan. And President Carter appointed me in 1978 at the age of 34 to the board as a Republican member. It was 2 Democrats and a Republican. And then Ronald Reagan defeated Jimmy Carter in the 1988 election. And Ronald Reagan named me as chairman because I was a Republican and the then chairman was a Democrat. So we just switched seats in offices. I was relatively well known for a young man because I had been writing and doing a lot of interesting work as a banking lawyer. And I thought someday I would like to serve in government, and so I was in charge of. I was at First Kentucky, the largest bank in Kentucky at the time, and I was in general counsel and in charge of investor relations and government relations. And I thought I'll just put my name up because there was a vacancy and see what happens. Because I'd like to see how the process works. Because when I'm old enough, I'd like to do this or something like this. And I put my name up and I got it. So I caught the car. Then I had to figure out what to do with it.
And once you caught that car, what did you do with it? Because you joined in 1981. That was the start when there was a lot of turmoil in the banking system. I mean, how often did it that you had to shut down a bank and take it over?
Well, actually, it started much sooner than 81 because I went on the board in 78. And the first day that I joined the FDIC. It was a day I won't forget. I was in Louisville, Kentucky. I had a dinner at the bank the night before, a farewell dinner, and the executive secretary of the FDIC flew out to Louisville from Washington, met me at the Galt House Hotel, which was right across the street from the bank, and I went in to the lobby and said hi to him and shook his hand and raised my hand to take the oath of office. He swore me in as a director of the FDIC right there in the lobby. We went outside and got a cab and drove to the airport and flew to Puerto Rico, where the second largest bank on the island was failing. The other 2 directors of the FDIC, one was the controller of the currency, who had his own agency to run. The other was the chairman of the FDIC, and I don't know what he was doing at the time, but he couldn't make it to Puerto Rico. So they asked me to go, which I did, and we flew to Puerto Rico and took over the second largest bank in Puerto Rico, and it failed. We broke it into 2 pieces. Half we sold to Banco Popular, which was the largest bank on the island, and the other part of it, the other 1/3 of it, we sold to Banco Santander from Spain. So that was my first day at the FDIC. I was the senior person on site.
Wow. What a story.
Not by age, just by rank.
And what was that like? Like when a bank is failing, what are the issues that you were presented with when, as soon as you landed the plane, people said, this is happening, this is happening, this is happening, this is a problem? Is it just people are pulling their money out and there's no money left?
Well, there wasn't a run on the bank. This was done quietly and quickly. It was which is how the FDIC behaves normally. Sometimes you have a lot of turmoil, but usually you prefer to go in and close a bank usually on a Friday, and you keep it closed over the weekend, and you open it on a Monday for business. The FDIC is very professional. It handles a lot of bank failures these days. It didn't used to, but the FDIC handles a lot of bank failures. The staff knows what it's doing, and you have the staff on hand usually well before the date of failure, as they help to get ready for it. And people do that quietly. You don't want to make a lot of noise because you want customers to be calm. And so that I would say that transaction went very well, and it was handled by a professional staff very professionally. And you needed a senior person there, such as a board member, in order that there can be decisions made on the scene. But the staff knows what they're doing, and they don't need a lot of direction from the board member who may be on hand.
And how is it the FDIC knows to shut down a bank before a bank run? Obviously, when you have a bank run, it's very visible and it's an emergency situation. But what were the signs of this bank, or a bank that fails shut down by the FDIC that's not a bank run? Is it just a trickle of deposits, a bank walk instead of a bank run? Is it credit issues?
Well, in that case, and in most cases, the FDIC has made it, and the state commissioner or the controller of the currency, whether it's a national or state bank. So the primary regulator and the FDIC have made a decision that the bank is no longer viable, and something has to be done, either to shut it down and pay off depositors, or most likely to merge it into another bank over a weekend and then reopen it, so that there's a minimum amount of fuss and delay. It's not a wild and crazy event normally. It's done very professionally and quickly and quietly, and the customers find out on it. It happens over a weekend. The customers on a Monday morning find out that there's a new bank in town, and everything's fine. Now, sometimes it gets a little more raucous, for example, when Penn Square failed. That was a notorious bank failure in 1982 when I was chairman of the FDIC. And it was in Oklahoma City. And it was a bank that had a lot of notoriety, and it was in the news. And it had a lot of problems and issues that were public. And there was a depositor run, and so we had to deal with it quickly. So that happens, and more than occasionally that happens, and you have to act very quickly. You take extraordinary measures. You may change the transaction to do it a certain way versus another way. But the FDIC's mission is to get in, get it done, and get it over with quickly, and keep it as calm as possible. That's not always possible. Continental Illinois, which failed in 1984, one of the largest bank failures ever, had a massive run. It was a $40 billion bank, and within about a week's time, it lost half of its deposits. So, and the way that was handled was the bank went to the Federal Reserve Bank of Chicago and borrowed $20 billion to meet those withdrawals. And then the FDIC worked as quickly as it could to decide how to handle it. We tried to do a merger with another bank, couldn't get one done that made sense in a reasonable period of time. So what we did is we basically nationalized it. The FDIC took over ownership of the bank. Acquired 80%. I think we put $5 billion or something like that in it, and took ownership over. I think it was about 80% of the bank, and we left 20% in the hands of the existing shareholders, and then we operated it that way for maybe 6 months or so until we could get it stabilized and fixed properly. and we did a transaction that was a permanent transaction, and we made a permanent capital infusion and so forth. Eventually, about 2 years after that, we sold that bank to Bank of America. So different transactions call for different techniques, and the main thing you want to do though is maintain calm. And I can tell you that one of the roughest, First Pennsylvania and Continental was a pretty rough time, but another one was we had the first large savings bank that failed in New York City. I think that was around 1980 or 81, and we were getting ready to do a takeover that would have been done quietly and quickly, and the story broke in a newspaper that we were getting to do that, and so all depositors in New York City started coming and wanting their money, and so we were not prepared for that. We were not ready for that, but we acted in an emergency manner, and we went in and did the transaction far quicker than and more hurriedly than we intended to, and we got it done. And we got the depositors their money, the ones that wanted it, and we took over the bank. But it was not a fun time. It was a lot of work and a lot of worry about whether that was, because this was an early bank failure. We had about several thousand bank failures in the 1980s, and this was one of the first major ones in a major city, and we did not get off to a good start because of leaks that got to the newspapers, and we learned some lessons from that and improved our methods. But we acted in a hurry, and we got it done in a hurry, and everything worked out fine. But it was a very difficult transaction, and we don't like those. We like to have things go much more smoothly.
You like it when it's boring.
Well, it's never boring because the stakes are pretty high, but and you got to pay attention and not so you don't make mistakes and so forth. But so it's never boring. But I'd like it to be a lot more peaceful than what we faced in Oklahoma City or New York City on those occasions.
And is there something about the media, about technology nowadays, where it's a lot easier for people to get worried about the banks and say withdraw their money, and then they're posting about it, and then other people withdraw their money, and they're doing it over a mobile deposit? So that's why Silicon Valley Bank, March 10th, had a tremendous outflow of deposits that was incredibly fast. Was it similar in the 1980s? Was there new technology, money market funds or other types of vehicles where it was actually easier for people to withdraw deposits? Not as easy as it is now, but easier than the 1950s and 60s.
All through that period, the 80s and the 90s, and even into the 2000s, you had the same problems. It's a little bit more difficult today because of the speed with which money flows. But it flowed pretty quickly back then too. I mean, let's take Continental Illinois. In the space of a week, they lost $20 billion, half their deposits, and they were basically withdrawals mostly from Japan. So, yeah, it wasn't an old-fashioned bank run. It was on the wires. So what we're experiencing today is not new. It's probably a little more common. Probably a little bit faster, particularly involving retail depositors. They used to have to come to the bank and line up, and actually, you almost rather would have it be done electronically because it's less of a mob scene, and the TV cameras taking pictures of the lines of people is not helpful, and so I almost would prefer that it be done quietly over the wires. But and either way, it's fast. This doesn't happen slowly.
When people want their money, they want their money.
Yep. Yeah. And I think we make a bit much of that now. I think what the FDIC has always tried to do is do things quickly and quietly, so you have as little panic as possible. And you try to be very reassuring. You want your money, you're going to get your money. It might be tomorrow instead of today, but you'll get your money. Don't worry. And so the FDIC tries to keep things as calm as possible. And sometimes it gets out of hand because the FDIC can't get its story out because people are acting so quickly by their mobile phones that they're not listening to FDIC. They're listening to all the rumor mill. Anyway, it can be complicated and challenging. Almost any time a bank fails, and sometimes it happens more quickly than others, and sometimes there's more notoriety than others. But it's not a picnic whenever it happens.
Yeah, I bet. And those depositors withdrawing money, in the case of Japanese depositors from Continental Illinois, were they withdrawing it to go to other banks or to money market funds? Because I know the rise of money market funds and the ability that they could give depositors or investors was higher, because there used to be a regulation, a cap on how high banks, or maybe just thrifts, you tell me, could charge. And then Paul Volcker, chair of the Federal Reserve, raised interest rates to such a high degree that if you could pay 6% on deposits, when interest rates are at 6%, that works. But when interest rates are at 18%, it just doesn't work. And obviously that's a parallel to today with Jay Powell has raised rates quite quickly as well.
That was a nightmare back then, and I'm sure it's not fun today. And I mean, I can tell all sorts of war stories.
Please.
But, Paul Volcker and the Fed raised the interest rates, the prime interest rate that banks lend on. He raised it to 21.5%. I mean, that was stunning, and that was from probably began somewhere around 7 or 8% back in 1978 or so. And when Paul Volcker came in 1979, he started moving the rates up, and they went up a long way, and they went up quickly. And it was a really horrendously difficult period. I mean, I don't have any problems with what the Fed did and what Paul Volcker did. I admire what they did. They did what they had to do, and it was effective. It stopped inflation, which was out of control. When we had to get inflation under control, they did. And then once the rates got to 21.5%, then we needed to go a different direction and try to get the economy more stabilized, and we did that. So I think what happened back then needed to happen. I wish we had done it this time a lot sooner, and I wish the Fed had not taken the interest rates down to close to zero and held them there for about 10 years. Those were the mistakes that were made, and now the Fed is doing what it has to do to clean up this problem that we've created for ourselves. So we're doing what we need to do with these rates. I know it's not fun. It wasn't fun for homeowners to see their mortgages go from 7 or 8% back in 1978 to, I don't know what they got up to. I think the home mortgage rates must have got up to something like 14 or 15%. And think of the small business loans and all the banks. I mean, all the farms that went broke. The farmers. Because they had debt on their land, and the interest rates went up, and they just couldn't afford it. And so it was a really, really difficult period, and the Fed did what it had to do. The FDIC did what it had to do, and it all worked. And fortunately, pretty much the politicians stayed out of it back in that period. I'm not saying we didn't get a lot of complaints, because we do get complaints always, but the politicians pretty much stayed out of it. They let the Fed and the FDIC do what they needed to do, and it all worked out in the end. I don't think we've handled things very well the last 20 years or so. There was a lot of damage done in the 80s, and we worked really hard to fix it, and then we incredibly decided to go back into all these problems, and we lost control of the deficits. We went from, in the year 2000, the last year of Clinton's administration, $5.6 trillion of federal debt, to $32 trillion or so today. Plus, The Fed had almost no debt back in that period on its balance sheet, about just under $1 trillion. And today, the Fed's debt is something like 11 or 12 trillion, in that range. So we've really made some serious monetary and fiscal mistakes in this country, and we don't seem to be able to recognize them and cure them, particularly the fiscal mistakes we've made. And so we're going to have to go through the problems some more. And that's, I really regret that. I think it's a shame. I think it's awful. It's irresponsible. But we did it, and now we've got to figure out how to fix it. It can be fixed, but it takes a lot of political courage, and the public's going to have to be calm and let the people do what they need to do. And the politicians are going to have to be supportive of the monetary authorities and to do what they need to do. I didn't mean to get into a big lecture there, but the two periods resemble each other a lot. And the first one didn't have to happen, the first period, the 80s. And clearly this one didn't need to happen because, we had just learned all those lessons. Why did we have to turn around and make the same mistakes again immediately? We at least could have waited 20 or 30 years.
Yeah, and let's take it for granted that relatively high, historically normal rates, 5%, but what over the past decade are high rates, are necessary to curb inflation. You seem to think that, and let's mainstream opinion. Let's just take that as a given. If that is the case, and interest rates have to stay at 5.5%, 6%, maybe even a little bit higher to curb inflation, that's from the Federal Reserve, what does that do to the banking system, where now we've had a lot of banks made a lot of mortgages at 2.5%, 3%, and now they're going to have to pay 4% or 5% to fund loans that are yielding them 3%, and they're fixed rate mortgages. You saw that experiment back in the 1980s. It was even more drastic then, and it was your job to clean it up. But what sort of happens? I mean, what's your outlook on? Are there going to be more bank failures? How systemic is this issue of, this bank has many billions of dollars of securities and mortgages that it bought or originated at ultra low yields that are no longer sustainable?
Back then, it was a lot more difficult to deal with because we had a public policy of providing by law. From the Depression forward, we wanted to promote home ownership. And so we wanted borrowers to be able to get relatively low rate, fixed rate mortgages. We wanted to promote housing and home ownership in the country. And so we also didn't want the banks and the thrifts competing for deposits and loans. We really tried to control competition because we didn't want so much competition that banks would do things that were not healthy economically. In other words, they would compete so hard on rates that they would make bad loans and bad decisions. So we really didn't want a lot of competition from the Depression forward. And we put the FDIC in place because we wanted depositors to feel safe and not have that money be fleeing quickly. We wanted that depositors to put their money in and feel really comfortable that the FDIC would take care of their money. If the bank made mistakes, the FDIC could fix it. And it was a good world, and it worked that way for 40 years. And then we lost our way, and we decided that we were willing to have more competition in banking. We allowed more banks to be formed. We allowed more branching to be done, and we allowed more competition among banks and thrifts and so forth. And it became a more dangerous world because banks were able to compete with each other, and then we allowed money market funds to compete with the banks, and that caused banks to do things that were riskier. They'd make riskier loans. They'd charge less money for them than they otherwise might, and so forth. And so that whole system broke down. And beginning around 1980, we had to deregulate the banking industry, largely deregulate it. and we allowed banks to have to compete with money market funds, and we allowed banks to branch in more places or go across interstate lines, and because we had no choice, because we reduced all those restraints on competition. And I'm not even going to preach about whether we should have done that or not. I'm just saying we did do it. And so it became a very different world. We had way too many banks and bank offices, because that was part of the thing we were doing. We were providing convenient services. We didn't want banks we wanted banks to be readily available to make all the loans they could to consumers and homeowners and farmers and so forth. And then we found that we had done too much of that, and that we had too many banks and they couldn't all compete. And so we really had to change the rules, and we opened up the playing field. And so we went from 13,000 banks in 1980 to 4,000 banks today. That's a stunning drop in the number of banks. But it also, we took off the interest rate controls. We let banks have much more freedom about pricing and the products they offered, and we allowed more people into the banking business to compete, non-banks and the like. And so it's a very different world, and the regulators have a lot of work to do to keep this stuff under control, and they don't always do it well. It was much easier being a regulator in 1940 than it is in 2020. Much easier back then, because there were fewer. I mean, it wasn't nearly as competitive and aggressive as it is today, and so we've had to change the way we do things. I'm not saying this is worse or better. It's just different, and so we have to recognize that. And I don't think we'll ever go back to that world. Maybe we will have another Great Depression and we'll have to go back, but I doubt it. And so I think that we are in a world that we need to understand better. We need to know how to regulate better, and we're learning those lessons, not fast enough. You talked about Silicon Valley Bank and the other recent failures. If you look at them, you wonder, why in the world did they fail? They were doing things, for the most part, that they shouldn't have been doing. Why? And I mean, they were growing very rapidly, and that's always a sign of future problems, in all likelihood. Why did the regulators let them do those things? They tripled in size in like 3 years. A couple of them, and they made longer-term loans on fixed-rate government bonds. Why would they do that? First, Pennsylvania did that back in 1978, and made that same bet, and the FDIC and the Fed had to come in and deal with it. It was the largest bank in Pennsylvania, the oldest national bank in the country. Why did we need to learn that lesson again? Well, I mean, we saw what happened back then, and you could say it was novel when it happened, and it was, but it's not novel today. You wonder why. Why did the regulators let them do that? They saw it. They did it. They weren't doing it quietly. They weren't doing it secretly. It was out in the open for all to see. Why did the regulators delay in getting on top of it? So I really think that back in the 80s, one of the things that I can say for sure, we were dealing with a lot of novel situations. Penn Square, Continental, all this stuff. We had First Pennsylvania. These were things the first of their kind. And we had a lot of lessons to learn, and we had a lot of cleanup to do, and we had a lot of rule changes to make. Why do we need to go through that again 20 years later? Or 30 years later, whatever it is. And I'm really disappointed that we didn't learn the lessons of the 1970s and 80s, and we had to go through the whole same thing again. And I know, Paul Volcker and I became friends. We didn't start out as friends. We didn't know each other, but we became very close friends, dear friends. And I tremendously admired him. And we talked a lot after he and I both left office. He lived in New York and I lived in Washington and Florida. And whenever I went to New York, I'd get together with him. We'd go to dinner or whatever. I'd go to his apartment. We'd talk. And I know how disappointed we both were when we saw that all those lessons we learned back in the 1980s and the expense of cleaning up this mess and the effort. It was incredible the amount of effort it took. And then we watched it and they were doing the same things again. They were making the same mistakes again.
Which mistakes and when? Early 2000s, 2010s, and what lessons?
From early 2000 to today. Now,
and that's you're talking about the deficit, so it really goes on the sovereign level. You're not talking about banking things specifically, just
the major problem in the 70s and 80s was a government out of control, fiscal policy, way too much debt, way too much federal debt, way too much spending without enough revenue. And then, the Fed monetized that and, it goes into the banking system and that leads to inflation and failures and all sorts of things. And we know what caused all those problems back then. We knew how that happened and we knew what we had to do to fix them, to clean it up. And it wasn't fun. And I know Paul Volcker and I talked about it a lot. Why are they doing the same things again? Why are they making these same mistakes again? It seems like we lost 2 decades for no good reason. And beginning in 2000, roughly 2000, through today, all those mistakes that were made back then by the government, by the federal government. I'm not saying there aren't other problems, and I'm not saying there aren't some state governments that did some things that were mistakes, but it was mostly the Congress and the federal government and the Fed made these mistakes back then, and they repeated them all again in this period. And I think that's just, it's shameful. It really is. We shouldn't be going through this mess again. We didn't need to learn this lesson again. I don't want to just keep on repeating the same things, but that's where we are. There's nothing new about this crisis, except this one is even less explainable. You just don't understand why people would do this again. This shouldn't surprise anybody in Congress that if you spend $30 trillion that you don't have, that it's going to cause a lot of economic problems and going to hurt a lot of people and businesses.
And the way that impacts the banking sector is how? Could you outline that? It's that inflation goes up and then interest rates go up, so banks own long-term fixed rate loans and bonds?
Well, it affects banks in many ways. For example, when prices go up and really high, it impacts consumers. They bought a house and now they can't afford the house, or a business. They've got the capital they thought they needed, but now prices are all going up through the ceiling, and they can't afford to run their business the way they need to run it. And they're going to have to raise prices, which means their customers' businesses are going to start losing money because they can't afford the debt. That's what bankrupted all the farms back in the late 1970s and early 1980s. They borrowed money to plant crops and buy their land, and then the interest rates went way up because inflation went up, and so the farmers couldn't afford their farms anymore. That's what happens. And usually there are people who win in times like that, but mostly they aren't ordinary folks who win, and they aren't farmers who win usually, and most businesses don't win. Some do, But it's not fair because the government's changing the game, the rules, after people have made all these financial commitments. The government's changing the price of money.
Well, some would say, Paul Volcker changed the price of money. It wasn't Congress. Congress spent a lot of money that, they borrowed it, so the Treasury had to borrow it, but it was the Federal Reserve that raised interest rates, right? When they have to pay more on their farm, don't look at the senator from Dakota, like look at, the Fed, right?
No, I think that Paul Volcker had to. Inflation is what caused the farm prices to rise. Okay, and Volcker had to, and the Fed had to kill inflation, and that meant rates have to go up, and that means anybody who's borrowed, not everybody, but most people who borrowed, are going to get hurt, because that's the consequence of rising interest rates, and rising interest rates are the consequence of high inflation, because you can't tolerate high inflation indefinitely, because it destroys everything. I mean, look at Brazil and Mexico and all the countries and what they went through, and we don't want that in the United States, and there's no need for it. I mean, not only is there no need for it, it is insane for a country like the United States to be doing the kinds of policies that it has been doing in terms of inflation and interest rates and big deficits that cause those things. It's insane. It really is, and nobody seems to care. In Washington, I know that there are people who care a lot, but right now they're not in control.
I'm going to tell you about Blockfills, a crypto trading solutions and financial technology firm. Since its launch in 2018, Blockfills has been ushering institutional investors into the digital assets marketplace with their array of services. Providing liquidity as a service, prime lending, their prolific over-the-counter desk, as well as their industry-leading SaaS suite, which includes the robust and sophisticated front-end trading platform Phoenix, as well as the all-encompassing trading order management and risk management platform Vision Crypto Cloud. The Blockfills SaaS suite simplifies all aspects of the trade cycle by combining robust technology with turnkey solutions to power digital trading. So visit blockfills.com/open to begin your onboarding process today. Thanks, and let's get back to the interview. And just on a political point, I know you were appointed by a Republican. Did it used to be the case that Republicans...
A Democrat first.
Democrat first. Thank you. Did it used to be the case, there is the stereotype that Republicans care more about fighting deficits and taming deficits than Democrats. But, when you look at the record, is that true? Because I think, Republicans, they like to cut taxes and not pay for the programs, and Democrats like to expand the programs. It's just, they both increase deficits, right? It's a bipartisan effort to increase the US
I don't think you could make a good case for the Republicans have been much less likely to spend money, and everybody's spending money. I would say that if I look when inflation takes off, it has tended to take off when Democrats are in power. And I don't mean to I'm not a highly partisan person. I actually think I'm going to say I'm not partisan. I'm trying to be as sane and middle of the road as you can be. But it's true that we had inflation take off in the 60s when we had the Vietnam War going on, plus the Great Society spending programs. And we didn't raise taxes to pay for those things. And those were during mostly Democratic administrations. And those, but I'll also give Carter credit for deciding to kill inflation when a couple of Republicans between the 60s and into the 70s, a couple of Republicans were in office, but they never controlled the Congress, and so the Republicans were trying to deal with inflation, but not very successfully. And then it was Jimmy Carter who came in and appointed Paul Volcker and said, fix this. And so I give Jimmy Carter a lot of credit for that. And then we go into the Reagan era, and followed by the Clinton era. And I'll give I know what Reagan did, a Republican did to try to bring inflation under control and to build a sound economy. He did. You can't deny that. But then Bill Clinton came in, and he, and with help from Newt Gingrich, really controlled federal spending and brought inflation, continued to bring inflation down, and kept the federal deficit under control, good control. At one time, we were talking about in the early 1990s, we're like if in the late 1990s, we were saying that we were going to be able to wipe out the federal deficit entirely because Clinton and Gingrich were running the country so well in terms of spending money and keeping the government spending under control. And then we go into the 2000s and beyond, for the next 20 some years. I don't recognize the fiscal policies, and I don't recognize the monetary policies. They were so wrong. They were so out of control. And we shouldn't have done that, but it was done by Democrats and Republicans, because you had George W. Bush in 2000, which is when this started, and we had the World Trade Center and the war in Iraq and that sort of stuff, and one thing led to another. And Obama comes in and he has a lot of deficit spending on domestic programs, and then Trump comes in. He had a lot of spending, and then you had the problems with COVID and all that, and then Biden comes in, and he seems to not recognize there are any limits. It's unbelievable how much money he's still giving away, $30 billion or $1 trillion to the student loan program, and I mean just things that are they don't make any sense. They really don't. And it's not just him, because there's a lot of people in the Congress that are doing that. I'm not trying to be partisan. I really am not. And I've named a bunch of names, and you see they're from both parties. So I think that, but we know what went wrong in the 80s, 70s, and 80s. We know what went wrong this time, and there's no excuse for not fixing it and stop this nonsense. It's so harmful to the people, to ordinary people.
So the mechanisms through which raising interest rates, higher interest rates, curb inflation, the mainstream ones I'll just list for our audience here are: it costs more to borrow, so people borrow less, so they spend less. It costs more to borrow, so they can do less speculative activity in financial assets. The discount rate is lower, all sorts of stuff. But it also seems like you're alluding to the fact that when interest rates are higher, it costs more for the government to borrow money. So it disinclines the government to run larger and larger fiscal deficits. Is that a theory that you believe in? And is that a theory that Paul Volcker believed in?
I'm not going to talk about Paul because he can't speak for himself right now, but he has lots of books he's written, and people can study him.
I got one. Yeah.
Yeah. Well, he's one of the greatest Americans we've ever known. And I have nothing but admiration for him. And he's just a brilliant guy, and so bold, and, had the public interest always in mind. But anyway, it does cost money to borrow, more money to borrow when rates go up, and that does make it more expensive for you to buy your house or run your business or buy your car, and therefore it tends to cause a reduction in demand, and inflation when inflation happens. There's a lot more money around, and prices that haven't yet risen. So there's a lot more money around, so there's a lot more demand for goods, and so goods naturally start to cost more. And we see that in so many ways. Go to the grocery store; it's going to cost you more to buy eggs and beef and so forth, everything. And it happens when you go to the gas pump. Gasoline's costing you a lot more, and by the way, I went to the FDIC in the late 70s, and my memory is that back in that era we had gasoline that was less than $1 a gallon. Maybe not when I went to the FDIC, but earlier than that, in that period. I mean, it shows you how much cost has been added, and how much less money we have in relation to the cost of goods. I mean, when the gasoline goes from $1 a gallon to $5 a gallon, that tells you you're going to take a lot more of your paycheck to go to work.
If your wages go up 5 times as well, then you're even. It's a push.
But they can't. I mean, eventually everything becomes too expensive for the ordinary folks. Now, if there are some people who do all right in an inflationary environment, and they tend to be people who have good jobs or good assets. They own a lot of assets, and so their assets are going up in value just fine. The price of a home just keeps on going up and up. If you already own the home and you don't have debt, that's a great deal. So it's rich folks who don't have a lot of debts that can get through inflationary periods just fine. But that's not very many of us. That's a very small proportion of our people, and it's not the 80% of the people who have a fairly normal life, who have debts.
But Bill, sorry, just returning to the point. So I think you said earlier in the interview, and I know you've said in previous interviews that thank Volcker for raising rates because he really got the deficit under control. The implication being, with higher interest rates, the government's going to spend less money. So is that a channel that you believe in? And I'll just, the reason I'm bringing it up, I was attempting to be sly about it, but now I'll sort of come out and just say is because, now the Federal Reserve believes in central bank independence. When a reporter asks Jay Powell, central bank independence, when a reporter asks Jay Powell, is the government spending too much money? He says, that's not my job. Did that always used to be the case?
I don't agree with that. I think it is his job.
Yeah. Okay.
I mean, he doesn't enact the legislation. Okay.
Yeah.
And he's probably saying that's what Congress is supposed to be doing, and the president is setting the budget. But I can tell you that most Fed chairmen that I've known, and I've known a few, I've almost always spoken out against excessive spending and have urged the Congress to get budgets under control. I know for sure Volcker did almost as soon as he got up in the morning and read his newspaper. I mean, he was quite clear about what he thought about government spending. But technically, it's not his job. The House enacts budgets, and the Senate approves them, and the president signs them. So that's where all that happens. And then, but the Fed, when the Congress spends a ton of money, there's a lot of pressure on the Fed to provide the money to support that. I mean, if Congress is spending all that money, the Fed tends to provide more currency and more bonds and so forth. So, they complain about it usually. Mm-hmm. I mean, I know Volcker, and I've seen a number of Fed chairmen and Greenspan. They normally complain. Maybe Jay Powell's too polite. He is a nice person, and he's not. Maybe he's not comfortable criticizing the Congress. But I know other Fed chairmen that I've known pretty well who were not afraid at all to criticize the Congress for uncontrolled fiscal policies.
What do you think, Bill, about the theory that the problem itself is inflation for all those reasons that you said? So if the government is running a large budget deficit and inflation is out of control, by all means, the government should for sure reduce and maybe even run a surplus. But if inflation is muted, like say at 1% or even in deflation, then a budget deficit by itself is not, an evil, bad thing. One thinks of Japan, for example, like inflation there. Well, now it's at 4%, 3%. But it was Japan struggled with deflation. So I guess maybe the example I'll give is that the U.S. was running a very large budget deficit in 2009, 10, 11 on a historical basis, but inflation was well below 2%. And that's, so what do you think about that theory that inflation is the real villain, not debt?
Which came first, the chicken or the egg? I think these things are all tied up with one another, and Japan does not have a great track record. Japan's economy was really, really strong in the 80s, and then they went through 20 years of just lackluster performance at best and falling population. I mean, Japan has not got a great record here, economic record over the last 30 years.
Right, but not inflation. It was very low growth and low inflation.
Well, they had a lot of problems and a lot of issues, and it was not fun for them to go through what they've been going through. And I admire the fact that they've really tried to keep going, and Japan has a lot of discipline, a lot more than we have had, and so I don't want to be critical of them, but I don't think their problems are the same problems we had, and also we are a country that provides leadership to the whole world, and we're supposed to be being responsible fiscally and monetarily, because we are the leader of that in the world. But although we're losing that position, if you look at what's going on, I mean, we have been the central bank of the world, and people and the currency that the world uses, the dollar, but we're losing that position because we're not doing a very good job of it. And I'm sure China would like to have that role. I'm not sure if they will. I'm not sure if they will have the discipline they need to take that role on. But no country has kept it forever. Eventually, it's too much for them. They can't maintain the discipline. And I'm hoping that we can prove that wrong. I'm hoping that we can prove that we can be the central bank for the world forever. The odds are against it. But I think there's no reason why we couldn't if we can maintain our discipline. And that's the tough part, because it means that we can't just do anything we want to do. If we want to give, we can't just tell all the students that we'll give you free college education. We'll pay off all your debts in college, which allows the colleges to spend more money, and the government pays it back because the students can't afford it. And we've got to stop stuff like that. And we need to. We know how to behave. We really do. This is not difficult stuff. The federal budget is. I mean, most of us as families have to deal with budget issues. We can't just spend anything we want because it seems like a good idea.
Right, but families can't print money. Governments can.
I know, but but which is why the families can't spend forever, and that's why businesses can't spend forever, because they can't print money.
Can't governments print forever? The limiting factor is demand for currency, based on inflation, and depreciates against other fiat currencies.
We see what happens when the governments start spending money that it doesn't have in large volumes. That's what caused the 1980s problems. That's what happened. That's what caused the Depression way back in the 30s. That's what happens. That's what's happening now. Governments, and we see it in other countries who once had a lot of power. I mean, Britain used to have the central bank for the world. It's not. It doesn't anymore. It couldn't carry off. Couldn't carry the burden and be disciplined long enough. And everybody that's tried it has not done it right. And I believe the FDIC, the USA could do it. I believe the United States does have the ability to do it if we can get some discipline and maintain it. And that's the hard part. This is not, to me, this is not difficult stuff. It's not rocket science. We know how much money a government can spend in relationship to the wealth of the country.
So is a surplus, in your view, frequently or always better than a deficit for government?
No.
Okay.
There are times World War II.
Yeah.
How are we not going to have a budget deficit there of consequence? I mean, significant consequence. But look what happened in World War II. We won it. We spent a ton of money, lost a lot of lives, but we won the war. And then we started after the war to demonstrate our leadership to the world. And we maintained responsible fiscal and monetary policies. And it didn't get out of control until, I would say, started to get out of control in the 60s. So we had 20 years where the government really behaved properly. The Fed and the Congress maintained discipline. They had deficits, but they weren't out of control. They weren't too large in terms of our ability to repay. And we did some great programs. The Interstate Highway Bill, wow, the TVA and all that. So we did a lot of investing, but we didn't do crazy things.
So Bill, just for our audience, two reasons why banks on the asset side fail. One is duration. Second is credit. Credit, you're not paid back. Duration is you are paid back or you can be paid back, but it's just interest rates have gone up, so the money that you're going to get is not worth as much. I think, and you can correct me if I'm wrong, all the banks that have failed this year have been because of duration. They've owned long-term assets that were a certain value and they're a lot less now that interest rates have risen and they have to pay more for deposits. How often during your tenure as running the FDIC was duration lurking at the scene of the crime versus credit?
Well, that's a good question, and they are separate issues, although sometimes related, because you've got duration issues eventually become credit issues. The reason why you have a problem with duration is you're losing money for so long. It's just eating up what your capital. But anyway, almost all banks, when they get into deep trouble, are either suffering from duration problems or credit quality problems. And sometimes they're intertwined too. But I don't know how to say what is what, but I would tell you that when we dealt with the inflation period problems in the 1970s and 80s, almost all of let's just take the thrifts. The savings and loans were required by law to make mortgage loans. That's about all they could do. And they were strongly encouraged to do them as long-term fixed-rate mortgages. So that's setting them up. If the climate stays the way it should be, where we're not overspending and causing inflation and all this sort of stuff, and interest rates will go up, that works, and it did work for 30, 40 years. But eventually. Well, and I'll take the savings bank industry, which the FDIC did insure. They were all about housing, all about long-term fixed rates, mortgages, and they were doing good things for the public. And they were doing what Congress and the regulators expected them to do. But then the government didn't keep its part of the bargain to keep rates decent in reasonable ranges. And it started to spend money on wars, Vietnam and so forth, and Great Society programs and all sorts of stuff, college programs. And they started spending a lot more money than they had. So prices start to go up. And then interest rates start to go up. And those savings and banks and savings and loans, which were doing their job that they were asked to do, suffered because interest rates went up, and they had all these long-term loans funded with low-cost deposits, And depositors said, we don't like the deposit rates anymore. We want to go to the money market funds and get twice as much interest. And so that's what they did. And it drove the savings and loans and the savings banks out of business. They couldn't afford to carry those long-term loans.
Do you think that's going to be a similar thing for banks these days? And if interest rates go up drastically, in this case from 0% to 5.5%, how can banks manage when they made all these mortgages at 3 or 4%?
Back in the bad old days, they couldn't, because they were not used to that new climate where interest rates are going to be that high and variable. But today, a bank is supposed to understand and manage its interest rates, and not hedge things, not just not just place bets on the current market. They're supposed to hedge their bets, and you can hedge things. And now that doesn't mean that somebody is going to lose somewhere along that line, because when banks and others hedge, they're betting, and somebody's got to take the other side of that bet. So the losses may show up somewhere.
But Bill, if you go through the annual reports and investor presentations of almost every bank, they all say that the more interest rates go up, the more they make money, because their deposits costs will go up by 20%, their deposit beta, and then they're making all these new loans at all these higher rates. They don't, I guess it's much more buried in the footnotes, the value, the impairment of the equity of the loans that they've already made. Was that also a problem in the 1980s where bank CEOs would say, "Hey, Bill, no issue. We're going to make more money the more rates go up"? Or
first of all, we have to segregate the thrifts from the banks. The thrifts would never claim that, because back in that day, because that was clear that when rates went up, they were not going to make money on that bet, because they were paying deposit costs that if they go up, they're getting fixed rate returns on the assets that they own. The bank's in trouble. The thrift's in trouble, because their cost of funding goes up, and their cost of on the interest rate they receive is not going to go up, because they're doing fixed rate loans back then.
Except on the new loans they make, but it was in a really inverted yield curve, and
they couldn't possibly make loans fast enough and at rates high enough to make up for the fact that their deposit costs were going through the roof. So anyway, I think that all I'm saying is that separate thrifts from banks, because they have different business models, or did. But commercial banks did largely make floating loans. I mean, whether it was a loan to a consumer or on a credit card, or whether it was a loan to a business, they have the ability to increase rates when their deposit costs go up. But that has a limit. And at some point, that interest rate cost becomes a big liability, because let's take the farmer. The bank that made farm loans, they had floating rate loans, but a farmer can't raise his food prices fast enough to keep up with this cost of the interest rates that are going up so fast. And so, all I'm saying is, yes, banks can hedge interest rates, and they try to, and they try to keep their deposit costs as low and as variable as they can. They try not to raise costs on deposits very fast, and they want to do it as little as possible and still retain the deposits. But they do try to raise their interest rates as fast as they can. But you have the limit of how much you can charge that farmer before the farmer can't afford it, period. Because their rates, their farm prices are not going to go up that fast. And if they do go up that fast, a bunch of other borrowers from banks are going to really be hurt, because they can't afford to eat. And so, there's nothing free in this. It's all got to follow the laws of economics. And so if you get rates moving too much too fast, people are going to get hurt. And that's why, I really am opposed to rapid growth in general, because most people can't cope with it. Most businesses can't cope with it. You'd think rapid growth is great. It is, within reason. Everything in moderation.
And I think I'm definitely Silicon Valley Bank. It was called a bank, but it could have been called Silicon Valley Thrift in terms of the duration exposure, because they made a lot of mortgages, and they also bought so many mortgage-backed securities, agency mortgage guaranteed by Fannie Mae, Ginnie Mae, that had a very similar duration component to a whole loan mortgage. It was just securitized. So, some things really, I guess, never change.
And what I just said, everything in moderation. And I think that's what banking really is about. And I think it's probably what government should be about. Don't do anything that's just out of line. That is not. Use moderation in whatever you're doing, whether it's the government or running a bank. Be moderate, and that will serve you well. And when you start, and can somebody create, let's say, a car, Tesla, and make $1 bazillion? Sure, but most of us can't do that. Most of us will never do that. And there are some people and some businesses that are new. There's a new thing, and it's exciting. They grow, and I Ford Motor Company way back when was one of those companies. But most companies aren't like that, and most households aren't like that. We get up in the morning and put our pants on and go to work, and we earn money if we work hard, and we watch what we spend. I mean, I think that the United States has been blessed, because not very many countries have ever had the wealth growth that we've had in this country. We've been blessed, but we sure had our ups and downs, and we make a lot of mistakes on the way. And it's funny, when I was at my first job in the banking world, as opposed to a lawyer, I was with a bank called First Kentucky. It was the largest bank in Kentucky. And I learned an important lesson then. The chairman of the bank had been running it for some time, and the bank had something like 40 consecutive years of increased operating earnings.
Pretty good.
Yeah. And I used to talk with him, and I say, well, how did you do that? I mean, nobody does that. He said, we're not smarter than anybody else. We're not luckier than anybody else. We just are more prudent than most. We don't believe that we know any more than anybody else knows. We don't think we're smarter. We don't think we make better decisions. But we do everything in moderation. We don't grow anything too fast. Because when you got growth rates that are beyond the norms, you're probably taking more risk.
But Bill, I want to ask you about that. So, I mean, you quoted the Financial Times. You said, we're kidding ourselves if we think there are only 4 problem banks in the country. What were that was a few months ago, shortly after Silicon Valley Bank failed, I believe. What was the prudence of the U.S. banking system? And I might add, is it systemic? Whereas if the Federal Reserve buys a ton of treasuries, does a ton of quantitative easing, and bank reserves explode higher, and then banks buy that collateral back from their customers, deposits mechanically are going to go up in the system. So, M2, money supply, is going to explode higher. And one bank can be, quote, prudent and reject deposits, but the entire system has to expand deposits. And, and then when they have those deposits, they have to invest in, mortgage-backed securities to have a good, net interest margin. So, yeah, what is the prudence of the entire U.S. banking system, and what motivated you to make that quote that, we were kidding ourselves to think there are only 4 problem banks.
Well, what I was thinking about at the time is the fact that we have gone through an enormous transition in this country that's still playing out. Banks are really heavy in commercial real estate loans, and just look at the cities. I've never seen so many tall buildings, new shiny buildings being built anywhere. They're all over the world, and you wonder. And I noticed it in China in particular, as I was over there in the 80s when they were becoming part of the world, and it was incredible. I can't remember, one of their largest cities, they sort of built it in like 10 years, and it was this great big city, and it was all vacant. They were waiting for people to move in, and it's not that bad everywhere, but of course that was a newly developing country, so they did do things faster than most. But my point is that in the United States, we have spent a lot of money on building up cities in the last 20, 30 years. And they're nice, pretty, shiny cities, and they had lots of people, and they were bustling, and it was fun. But now, a lot of people don't want to live there. They want to work from home. And COVID sort of pushed that into the forefront, but it was probably going to happen whether or not we had COVID, because all of the improvements in technology made it possible to work from home. Take me. I'm sitting here in Sarasota, Florida.
Hey, I'm in New York.
Talking business to you. And I could be talking to a banker right now doing some deal because we can. And if I can do this over the internet and have this conversation, it's a lot better than having to drive to work an hour each way every day, or to live in the middle of a crowded city. Instead, I look at the ocean here. So what I'm saying is that we have a lot of alternatives to living in all these wonderful towers we built. And a lot of people are making that choice. And then a lot of people are leaving places that are too crowded to go to places that have oceans and things like that. There's a lot of shifting of people. That means we have a bunch of buildings, just as the Chinese do, a bunch of buildings that are not fully utilized and are therefore probably losing money. Certainly they're making less money than they were intended to. And so we probably are going to have to figure out a way to deal with not probably, we're going to have to figure out a way to deal with that. Maybe it's just having more population growth until they get and stop building so fast, so that we get those buildings more fully occupied, and maybe the prices go up because there is more demand in relationship to supply. But we're probably going to have a period where that real estate's not going to make the kind of money it was intended to make, and that means we're probably going to have some losses.
For equity holders, real estate developers, maybe. But what about the bank? Do you think that could extend to the banks? And there could,
the banks didn't used to make a lot of real estate loans, for commercial loans, because that was usually the province of the insurance companies. And that was true in the 80s. I know that insurance companies had a lot of the real estate, and they could do that because they had different funding. Insurance companies were collecting premiums on policies that stayed in place until you died 80 years later. And so they had more stable money. They didn't have depositors coming in and drop their paycheck in the bank, which they would start to spend. So I think that insurance companies generally financed, and other long-term lenders generally financed, the commercial real estate, and the banks didn't do much of that. I think the banks are more involved in that now.
They definitely are, yeah.
And that's harder for them to do because they don't have the stable long-term source of money that insurance companies had, and long-term investment funds and the like. So we do have some duration issues, I think, and I think some banks are gonna have to deal with that, and 3 or 4 of them just did.
Yeah. Well, they didn't deal with them, and then they got taken out.
Well, I meant
Yeah.
they either deal with them or the government will deal with it for them. That happens, and the question is how much of it is going to happen, and how quickly, how severely. I'm not overly concerned. I'd be lying to you if I said I didn't have any concerns. I mean, after what we just saw with Silicon Valley Bank and First Republic and the one in New York, Signature, I think its name was, and of course that was not so much real estate as crypto and all sorts of things. But I think that I'm not going to say that there isn't another one or two or here and there. I don't think we're going to have a crisis we can't handle. I really don't. But if Congress doesn't wake up and deal with the real culprit here that set all this off, too much money being pushed around too fast at too low rates. Who came up with the idea that we should have 0% interest rates in this country or any country? I really don't know who came up with that idea, because back in the 80s, when things or let's say the 70s and 60s, when things were more normal, rates were going up. In the 50s, rates were way down. The 60s and 70s, they go up, but in the 50s, they were never zero or close to zero. The mortgage might have been 5%, and then in the 60s, it might have been 6 or 7%. In the 70s, it was 8% maybe. In the 80s, they went through the roof because we were trying to stop the inflation and stop this massive growth in money. So who decided in the year 2010 or thereabouts that it would be a good idea for the world to go from whatever it was, let's say 7 or 8% interest at that point in the 2000s. Let's say 7% interest rates was sort of the norm. Who came up with this brilliant idea that money should be free?
The Fed, because huge recession.
Huh?
There was a huge financial collapse. 2008, Lehman.
Lehman wasn't a huge financial collapse. We turned it into a huge collapse, but it didn't need to be.
How did we turn it into a huge financial collapse?
Well, we adopted TARP and sent $750 billion into the economy.
And that made things worse, you think?
Oh, yeah. Sure.
So how would banks have the wholesale funding markets of banks, how would that have worked out where no one is lending to anyone and the collateral that's been pledged, it's either worth way less than it is, or even if it's good collateral, there's a total collapse of confidence, and there's just tons of bad loans on the banking, on the balance sheets.
There were not tons of bad loans in the banking industry in 2008. There were a number of bad loans in the financial system as a whole. The banking system was actually healthier than most of the rest of the financial system.
So you're talking banking that take deposits. I'm including investment banks like Bear Stearns, Lehman Brothers, Goldman Sachs, which did not fund themselves with deposits, FDIC's realm, but funded themselves in the wholesale repo markets.
I understand the way the system works.
No, I'm for the audience. Yeah.
But I'm saying that the failure of Lehman, the failure of Merrill Lynch. What happened to Merrill Lynch? Merrill Lynch failed. Largest investment banking firm in the world. It failed. Bank of America bought it. Mm-hmm. End of story. It's been a huge success. So, I mean, Lehman, I can't remember, but I think it was J.P. Morgan bought it, right?
Lehman went bankrupt, and then I think some of the assets were sold to Barclays.
Somebody bought it. I don't remember. But
the whole Bank of America deal. I mean, the Fed was working the phone lines, right? I mean, it was not just private industry.
The Fed said to B of A. Well, B of A entered into a deal to buy Merrill, a part of Merrill, and then they did all this due diligence, and they said, "No, that's not for us." because we don't want to take on that problem. And the feds, I'm going to use that word plural rather than the Fed. The feds said, we need you to buy that. So buy it. And if you don't, we're not going to be happy with you, and you don't want that. So they bought it. B of A is one of the strongest financial institutions in the world now, after having bought that institution. So, when they bought Merrill. I mean, Merrill was a great firm. It got into trouble. It needed help. It needed have a stronger partner. They got one in B of A, and they're, as far as I know, they're pretty happy with themselves right now. Did they have to do some work? Sure, but it all worked out. Why we decided we were going to dump $750 billion of taxpayer money into the financial system, I don't know. TARP was a terrible program.
I understand the point about moral hazard, but I don't understand how that can't be stimulative to buy a bunch of toxic loans from bad banks.
First of all, if you buy toxic loans from bad banks, $750 billion of them, who's going to manage them? Treasury?
Sure.
Treasury?
Sure.
You want to turn $750 billion of bad loans to the civil servants of Treasury. I wouldn't want to do that. And also, by the way, neither did Paulson in the end. Because what he did was he abandoned the $750 billion program. He did not use it, except what he did is he made a bunch of loans to banks that didn't need the loans. Maybe a few that needed it. But he mostly forced $750 billion off into the capital of banks. You know what that happens when you do that? When you add banks $750 billion of capital, they loan multiples of that out.
But they didn't. Loan growth was extremely low in 2009, 10, 11.
Well, I'm not worried about 2009. I'm worried about the next 10 years and 15 years after that.
Okay.
They made a horrible decision to force the banks to take those loans. And I can tell you that one banker, Dick Kovacevic of Wells Fargo, when the Treasury told him that Wells Fargo was going to have to accept a $25 billion capital infusion from TARP, Kovacevic, in a meeting with all, a number of large banks and stuff, he was told by Paulson, "See that woman over there?" And Kovacevic says, "Yeah. She runs the FDIC, and she's going to be in your bank on Monday if you don't take this money. And you're going to regret your decision not to take the money. I guarantee you." So Kovacevic took the money. And that's happened with a lot of banks. And we put so much money out there, interest rates go to zero, and nothing's normal anymore. Nothing's normal anymore. How can you have a regulated banking system, one that's regulated by regulators and one that's regulated by the markets, when the banks don't get interest? And borrowers are not charged interest. I mean, it doesn't work, which is why
the sun rose. I mean, every day the sun rose, the sun fell, the moon rose. I mean, it's weird. It's ahistorical for sure. But the ahistorical, I said. But a 4% deposit rate and 6% on loans, that's the same net interest margin as 0 and 2.
It wasn't even that, but that was way lower than the market had been for a long time. But and if it were 4 and 6, okay, that's maybe for a short period of time. But you can't have a market-oriented banking system if you don't have markets. You don't have markets. You don't have rates. And that's what we did. We took interest rates globally to 0 and kept them there for 10 years. And then we wonder why we have problems.
And ironically, bank lending was very low from 2008 2009 to 2019, bank lending was low and much, much lower than when you were at the FDIC or when rates were at 15%.
They were lower.
Interest rates were lower from 2009 to 2019, but banks lent a lot less money. Loan growth.
Oh, well, in 2008, 2009, banks were scared.
Yeah, but the decade after, for sure. I mean, now it's coming back big time.
From 2010 to 2020, we did not have markets that were functioning properly because interest rates were near zero globally. How can you have a banking system that's not market-based? How are you going to decide who gets the money? What projects can be supported? To me, I don't understand why somebody didn't ask this question long ago.
But are you surprised, Bill, that this is the system function? I mean, it wasn't that different.
No, it was a lot different.
Okay, tell me.
A lot different. I can't comprehend how somebody decided that this was a good idea. I know what we'll do. We'll make everything right in the banking system. We're going to get rid of interest rates, period. How are you going to decide who gets the money? How are you going to decide what projects you're going to finance, whether they're good or bad?
Well, it's still a spread. Instead of the spread over the risk-free rate of 5, it's the spread over the risk rate of 0.2.
What?
Instead of everything being priced, I mean, everything priced off a spread off of the risk-free rate, and if that risk-free rate is 5, 5.2, now it's 0.2.
And you think 0.2 is going to have a material effect on decisions?
I don't know.
If I want to buy a house,
yeah,
and I have to pay a 7% mortgage, that will go into my calculation of what I can afford. I know what my salary is. I know what my expenses are, blah, 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 what the taxes are, the maintenance and all that. And I know what I can afford. If the cost of that mortgage is 0.25.
Well, but it's 3%. Yeah.
Well, I can tell you the house I'm living in right now, I got the rate down to I think it was 2.5%.
2.5, yeah.
I can afford a much bigger house at 2.5%.
Yeah.
Than I can when the rate's 7%. We have a market-based system in this country, and probably most countries, although us probably more than most. We depend on markets to help us to help us allocate resources.
Yeah, but I would say that since pretty much 1913, 1914, or really 1929, the short-term interest rates have been set by the Federal Reserve, not a market. And Paul Volcker raising interest rates to 20% is just because he wants to constrain the economy, because the economy is running so hot and inflation is so high. That is just as artificial as interest rates at 0, because the economy is so weak that it needs a boost.
And what Paul Volcker did in taking interest rates from, say, 8% to 21% was an extraordinary measure that you would not normally want to see, and you wouldn't want to see it for very long. Because what he was trying to do is kill inflation. And the only way to do that was to limit demand. And you limit demand by raising prices. Okay? And so I agree that if Paul Volcker had kept interest rates at 21% for 10 years, there wouldn't be much left of the country.
Yeah.
Okay? We certainly wouldn't have any shiny new buildings.
No.
And so that would have been a bad thing. And Paul Volcker knew full well that would be a bad thing. But he also knew that, we were in extremis. I mean, we needed a really stern, tough shot of penicillin or whatever to get this economy well and get it down to normal. Because you can't. It's like you're running in a marathon for 40 miles. you can't do that. Your body can't handle it. And so Paul Volcker knew that. But you also can't go home and lie in bed for 40 years. I mean, your body needs some exercise. You need to have it functioning, and that's that's a terrible analogy I'm making, but you know, it doesn't make any sense to have an economy with 21% interest rates for an indeterminate period of time. And just as it doesn't make any sense to have rates anywhere near zero for a significant length of time. Both of them are radical things. And maybe the folks who handled the 2008 period, and I think Bernanke was the chairman of the Fed, and followed by Yellen and so forth. But maybe the people who handled that period had really good thinking when they said we need to get interest rates down to close to 2%, 3%, 4%, somewhere really low to get this economy back in the right place, get it strong enough that it can survive and grow. They might have been right on that. I don't know. That's
Me
their
neither.
job.
I don't know.
And maybe Paul Volcker was right that he had to get interest rates up to 21% to get the economy calmed down so that it could function normally. And I believe he did do the right thing. I believe he was a very smart man and knew what he was doing. But some people don't. Some people thought he shouldn't have done it. I think you might think he shouldn't have done it. But but that's your right and my right to say I think he did the right thing. And I don't know, but I don't know how anybody could argue that Paul Volcker should have gone to 21% as long as he cared to.
Yeah, I'd agree with you that I honestly don't have a strong view on whether 20% was necessary. I really don't. I was more defending why interest rates had to be so low, in 2008, 2009.
I'm sort of agreeing with you that I'm not going to second guess those who thought I can't second guess Paul Volcker on 21%. Okay.
Yeah. No, nor do I want to.
And I can't second guess Bernanke or whoever was in power at the time on 3%.
Yeah.
Or whatever. That's fine. I mean, these people are doing a very difficult job, and they got to make some tough calls, and it's not all pure science. You got some judgment you got to use.
Definitely not pure science, and the rules and relationships change all the time, and probably 10% of things that are relevant you have control over, and the 90% you don't have control over. And I just looked it up. So like in 2013, inflation was at 1% and the unemployment rate was at 7.6%, close to 8%. So, if you're a believer in the dual mandate, which the Federal Reserve is, of low unemployment and 2% inflation, you're not there yet, right?
The point I'm trying to make is that I can't second guess Paul Volcker at 21% for a year or two, whatever it was. It seemed reasonable to me at the time. And was he too high? Maybe a little bit. Could he have been done a little better if he'd been a little lower? Maybe. And I'm not going to second guess the Fed at 3%. Let's say 3% in 2013. Okay.
Yeah.
Maybe that. Maybe even 2%. I don't know.
Yeah.
I'm not that smart, and
I'm definitely not that smart. Yeah, and I think they're. Some papers coming out that they're diminishing returns to zero. And I mean, the track record of negative rates is quite poor. I mean, you have negative rates in Europe and they don't have a booming economy. So that extra stimulus from 2% to zero, or you're even negative 50 basis points, it's maybe the juice isn't worth the squeeze. I totally agree.
I wouldn't have complained about any of that if they had done it for a reasonable period of time. And what's a reasonable period of time? I don't know, a year, 2 years, just like whatever Volcker had to decide about 21%. But they came up with a theory that money could be at near zero for a decade and not have any strange effects, not any bad effects. And I'm 100% confident that was a bad plan.
Yeah, I think you could be right. I mean, we haven't even talked about quantitative easing, but we'll leave it there. Bill, thank you so much for being so generous with your insights and time. We run long, so I appreciate it. Where can people, if they want to, learn more about your work and your firm, where can they go?
Well, the firm, and by the way, I hope you don't want to come and visit me with a gun and all that sort of stuff.
No.
No, I'm just joking, but
Yeah,
it's a crazy
well,
world.
like they did with Volcker with they threw a brick through his window or something.
Well, a guy walks into the Fed boardroom with a overcoat, and he has a shotgun inside his overcoat.
Wow, I didn't know that.
He's sitting. He's right outside the board room, and the FDIC had some of its offices bombed in the Midwest because of the farmers all concerned about things, and so there are some crazy people in this world, and I'm not too concerned about it. I've had a good life and basically have been very, very privileged to lead this life and be able to be in the public arena. But let me just say, I really appreciate this conversation. You don't get a chance very often to have an extended conversation. When you give an interview on TV, if your answer is longer than 30 seconds, the questioner runs out of patience pretty quickly. And so to be able to have this back and forth, I tell you that I really enjoy this because you don't get a chance to have extended conversations like this when you do an interview, and not everybody is as well informed as you are. It's been fun to have some banter.
Well, thank you. I so appreciate that, and I enjoy the chance to banter with someone who literally ran the FDIC during the early part of the savings and loan crisis. And yeah, I mean, you're thinking just about debt going back to the sovereign level. You're focusing much more on the government than on the banking, which I expected. But I have to say, yeah, in 2020 and 2021, and there was so much money printing that I think your theories are dead accurate to describe what occurred. Where, if the government's not spending that much money and the Fed's doing QE, okay, that's one thing. They're just, printing bank reserves and that's it. But when the government is borrowing money from the Fed, who's trillions of dollars, and then they're just giving it to people, and they're giving it to companies, and they're giving it to everyone, I mean, that is going to cause inflation. So I'm with you. I am not one of those people. I just want to clarify who says, oh, the reason inflation was at 9% is because of supply chain. Obviously, that played a role. In the same way, oil, the reason the price of gas went from $1 to $5 is because of OPEC in 1974. But there's a secular driver of inflation, which is money printing. So I just want to be in the. I view myself as a moderate. I'm not I'm not someone who's defending negative rates forever.
I understand that, and I know that but first of all, you're trying to be provocative to some extent, and that's what makes interviews interesting is when they get provocative. But I know that you are not a crazy, and if I thought you were, I'm not sure how long this interview would have lasted. Not very long.
Well, thank you so much, Bill, and thank you everyone for watching.
Thank you. Take care.